Hey everybody, Scott Riley, the Market Update Desk and Mortgage One, September 19th. So let's get into what's going on in the market today. We got a bunch going on with the Fed and commentary, housing information, and getting ready for Fed decision tomorrow. So today, Treasury Secretary Yellen came out and said the consumer spending still remains quite robust and there are no signs of economic downturn. She has been, though, more of a promoter of the economy and has been, from time to time, way off on her commentary, which is why her comments that the labor market is showing signs of cooling does carry some significant weight, and the situation likely could be starting to erode. Kaplan, former Dallas Fed president, said the strength of the economy is weaker than it appears, which we here at the Market Update Desk do agree with. Both Kaplan and Lackler, former Richmond Fed president, also said the labor market is cooling. So it's a lot of information and commentary regarding the labor market. So housing starts, permits, completions, that all came out today. So let's dive into it. Housing starts fell by 11% in August to 1.283 million annualized rate, which was well below the estimates. Starts are now down 15% year over year. The decline, though, thankfully for residential, was mostly in the multifamily mix. The decline was mostly, like I said, in the multifamily, and those fell by 342,000. While there are a lot of apartment buildings under construction, there are significantly fewer now starting to go under development and conception. Single family starts, which are most important, fell by 4% last month at a 941,000 unit pace and are up 2% year over year. Housing permits, which is a forecaster of future supply, were up 7% to 1.543 million annualized, which is down 3% from last year. Single family, though, were up 2% month over month and up 7% year over year. Housing completions rose by 5% last month, while single family was up a total of 7%. When we look at new supply of completed homes that are on pace to come to the market this year, that is about 1.4 million. Now, if you subtract out the 100,000 homes that generally need to be replaced every year for aging, that brings our total figure to about 1.3 million net, which is well below the forecasted household formations of 2 million. What this means is more demand than supply will continue for the foreseeable future. The NAHB, National Association of Home Builders Housing Matrix, this measures builders' confidence in multiple different areas. So the September housing market matrix, which measures, like I said, their confidence, fell a total of 5% to 45, falling below a very important 50 level, which it hasn't been there since April. All of the internals fell. Current sales confidence fell 6 points from 57 to 51. Future expectations fell 6 points from 55 to 49. That's significant here. Move my notes around just a little bit. Buyer traffic fell 5 points from 35 to 30. The reason being for the decline, pretty straightforward. Mortgage rates, and then shortage of workers, shortage of buildable lots, and what's very interesting is when you read into it, a shortage of distribution of transformers, which are needed to connect homes to the grid. So very important stuff going on there. CoreLogic rental report also came out today. They reported rent prices went up 3.1% year over year, which is now down from the previous month of 3.3. So we're showing consistent positive signs in a lower net rental costs, and that starts to impact inflation through the CPI report and PCE. So on a technical basis, we're staying pretty flat today. Mortgage-backed securities are down about 14. 10-year Treasury is up 1. In fact, the 10-year Treasury did test the top level of resistance of 4.36 this morning, which it does continue to hold. It bounced down from it. This is a very big critical level. And where we go from here is going to be a direct relationship to what the Fed comments are going to be tomorrow. Now, keep in mind, the Fed is meeting today, but their comments will roll out tomorrow. One other quick interesting fact, oil prices over the last 2 years have spiked in August, September, and October. And then we've started to see a significant decline in oil prices in November, December. So what that means is maybe we'll start to get some relief at the gas pump, but also that trickles into inflation and spending. So if we can get some lower oil and gasoline prices, we start to lower some of those inflationary aspects. So want to get all that to you. Hope your week is going well. Give us a call to get pre-approved, 616-293-2189. You'll see kind of a cool banner that we had made is in back of us. And we're excited about that and some other things that are going to roll out for the market update desk very shortly. Thanks so much and have a great day.